This makes complete sense. There is a DeFi and there is traditional finance. And with institutional DeFi, yes, we are trying to find a middle ground. And institutions definitely want to probably, kind of disrupt this DeFi industry. And following this will be my question to Michael. You have worked in senior positions with Goldman Sachs. You know how institutions work, how, especially the financial institutions, what their culture is like, how they work, how their operations are. What do you feel is attracting them about DeFi, and what kind of services these financial institutions can offer if they enter the DeFi industry?
Yeah. Look, financial institutions at the end of the day are there to serve clients, and the clients typically set the agenda. So until the last 18 months, banks have been quiet on offering crypto-related services because there really wasn't the mainstream push. Then it kicked off with JP Morgan, and a lot of the large American banks are following suit, where their clients are requesting. If you look at pension funds in Australia, for instance, each of the major pension funds, the superannuation funds in Australia, at their annual general meeting, there were questions from the members about what is the crypto strategy for the fund. So it's driven by clients. Now, institutions work, they're typically licensed, so they work within strict regulatory frameworks, and the frameworks are typically there to protect end users. So the institutions now are looking for how to bring what DeFi is typically designed around whatever the developer wanted it to work. The mechanics are written, it's very transparent, but at the end of the day, it was an individual or a group of individuals that wrote it. And I'm not necessarily talking about the latest offerings, but Bitcoin, for example, right? It was an academic exercise at the start. So then the institutions recognize that the clients want this class of asset, they want the risk exposure. So how do you deliver it? Do you sell them directly the coins and they hold? Do you hold direct exposure coins as a custodial product? Do you offer economic exposure on swap, where the bank holds the asset and they enter into a put call swap or a total return swap, where you settle a mark to market daily, so there's an economic return and the client never has to touch it. And I think Jonathan touched on this slightly earlier around what assets can even a company or a sophisticated organization hold. There's the practicalities of holding these things, but then there's the charter of an organization that maybe they're not allowed to hold indirect equity investments. It's probably totally silent on digital assets, for instance. So the banks are looking to be clever to meet client demand for exposure to the assets, and it's sort of melding exposure that they offer clients today, so the mechanics, so as I mentioned, swap or custody arrangements, to the underlying risk instrument, being Bitcoin or whatever it is. So we're going to see some interesting products come up, and then there's more fiat-based ones like margin lending, right? Where we've seen margin lending take off in crypto. These sorts of fiat concepts that have been around for ages, and melding the risk element, the crypto on the back, and how these things are offered and the sophistication and who they're offered to is evolving, because regulations globally are not up to the levels that we would like. They're not prescriptive enough. So there's a lot of sort of reading between the lines and going to regulators and getting guidance. But this is all this all is part of adoption, right? There are early movers that are institutions. There's some very large ones. The biggest bank in Australia, Commonwealth Bank, announced recently that they're going to be offering crypto solutions to their clients. Specifically what they are, we don't know, but one could presume holding and potentially buying and selling. So the demand is there. It's driven by clients, and the institutions work within the frameworks that their licensing regime, what they're part of, and it's what they can deliver within that regime. Because if you're familiar and comfortable with banks, and you can get exposure to the new asset class, that's when this becomes mainstream. And the great example is credit cards, where you're paying in crypto, right? It's using a construct of fiat that's been around for ages. The underlying risk, however, is crypto. It's a great example, and I think we will see more and more smart, clever meldings of the old and new world, if you like, as regulation increases and people have some level of comfort, whether it be a bank or it's a Visa or a MasterCard, and the risk elements of crypto are there. And then you see the efficiencies of blockchain, for instance, for settlement and non-crypto specific, even just blockchain specific solutions. You've seen a lot of solutions in the NFT space for KYC and credit scoring and things like that. That's when this becomes mainstream, when these technologies are adopted. And the folks that are really going to push it on the masses are the institutions. So they play a very, very important part, in our opinion, or in my opinion.